Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss with you the subject of what we should invest in 2022. So since we've just started the new year, I figured I would go through and discuss a little bit in this and a series of other videos about predictions and things upcoming. Super dangerous to do because, of course, the reality is that lots can change. It's really, really difficult to look into the future. But that being said, because this is an issue that I've been thinking about a lot myself, I've had a fairly large portion of my portfolio over the last little bit in cash as I've kind of taken profits from various different things, plus accumulated more income, etc. I figured it would be worth thinking through with you the logic on what it is that we can and should be investing in at this point in time based on the current conditions. And it is a question that comes up with various different clients, so we're going to dive in. Before we do, I'm curious to hear what you think. If you were to kind of look at the spectrum of where we are in the world, first of all, I'd love to hear your opinion on just kind of the macro analysis of where everything is at, and then what you see as being good investments right now and why. So would love to hear that from you. Let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notifications bell. If you'd like help with the topics we deal with here, which are forming companies abroad, international tax optimization, getting residencies and citizenships, relocating to other countries, etc., please reach out to me. You can book a call at calendly.com/Michael-Rosmer. There's a link in the description below, or send a message to our websites, offshorecitizen.net and offshorecapitalist.com. Okay, so I'm going to kind of set the context here a little bit on where we're at. So since, kind of the lows around March, April 2020, the markets have pretty broadly gone up a lot. Now, not everything at the same time, but prices are up almost across the board to a very large degree. We are, by some standards, what you might call in the mother of all bubbles. And what I mean by this is there's not a lot of places that something hasn't gone up. And this makes you beg the question, okay, well, if everything's up, where is it safe to invest? And where is that we find yield? I've done some videos previously discussing really the important conversation of risk to reward, right? And discussing how a lot of things that even if they might be, it might be possible that they're gonna go up, you might get some yield there. The risk to reward might not be great. And certainly when everything has gone up a lot, then that is a bad indicator for the future prospects of, well, a lot of these things. At the same time, we do have the possibility of kind of some different macroeconomic environments. We've talked about this in some previous videos regarding how the overall supply of money could decrease if the kind of federal central banks take advantage of tapering, increase interest rates, plus we've got inflation concerns, etc. Right? So we've got a lot of different factors that could make it dicey and again affect the risk to reward from a macro standpoint. And then at the same time, we say, okay, well, we don't want to just sit on cash because what if we do that and we're wrong, right? So in an environment that has been over the last couple of years quite inflationary, we can argue about whether we think that inflation is going to continue or at what pace, but that certainly doesn't make it great to sit on cash, right? At the same time, assets are quite high, and if things don't go the way that we expect, we can see those asset prices drop a lot, in which case you would have been better off sitting in cash and buying at lower prices. So where does this leave us? I think this leaves us in a few different kind of quadrants of what to look at. So for the most part, I don't think it's super wise to buy highly volatile, non-productive assets. Okay, so for example, the crypto markets have done really well, mainly through 2020 through 2021. 2021 kind of less so, basically about around the late spring, early summer. There was kind of, unless you were in NFTs and metaverse, maybe a few other ecosystems, you didn't do incredibly great. A lot of things have been fairly flat. This being said, there was a lot of growth there. Bitcoin obviously had more or less peaked in April and then peaked slightly higher here recently. Now some people are saying, is the bull market over? Is it not? What are we looking at for highs, etc.? I tend to be somebody who doesn't particularly believe the idea that we're going to see a parabolic blow off top. I've discussed that a little bit previously. And so, if you add to this the fact that there's a lot more projects on the market, combined with not a huge, large increase in the amount of capital flowing in, I think you're going to have to be much more selective about projects in order to get some good wins, both in terms of your buy points as well as in terms of which project in particular you choose. So it's a tougher game this year, in my opinion, than it was in some previous years. On the flip side, you could look and say, okay, well, a bunch of tech stocks are down from their highs previously. We saw a bit of a pullback. In particular, Chinese tech, Alibaba and Tencent is deeply discounted from where it was. But on the other hand, there's a lot of geopolitical risk there, I guess just political risk in terms of how China is handling them. And so, does it make sense to buy in? Questionable, right? So we've got those things where you could conceivably see, like, it wouldn't be hard to imply that, I think as I'm filming this, Bitcoin is around $47,000, dropping down to 30,000, sorry, would not be an unheard of possibility in the next year, which is a pretty big drop. You're talking about, about 33%, a little bit more, around 40% really. And so you've got the possibility of maybe a 40%, possibly greater downside. And what's the potential upside? Is it, double? It's not a great risk to reward, right? A lot of commodities, I think, probably aren't going to see a huge run in this particular stage. Again, there's something that's run up. This, again, we can kind of look at stocks. Okay, maybe like we're probably going to see, you usually have an environment where some do well, but sector-wide, I think, kind of difficult to play that game. So yes, in any of these given categories, if you're skillful and if you're knowledgeable and you have insider information or you're on the pulse of things, yeah, you can do great in, all kinds of different fields. So this is not me saying those are going to do badly. But what I am saying is that for a general person who maybe doesn't have the time to invest into extensive research, hasn't networked into the space, doesn't have access to early stage deal flow, things like this, you're in a situation where just randomly picking winners and having good risk to reward is probably not fantastic in this year. So where does this leave us? In my opinion, it leaves us principally with wanting to focus on two key characteristics of our investments. At least this is my perspective. Number one is cash flow. So what I want to do is I want to put myself in a position where I'm mitigating some of the risk. Now, you can conventionally mitigate the risk by buying lower, by having with good risk to reward, buying in a situation where the markets have just had a major sell-off, potentially buying appreciating assets, or productive assets. These are all different strategies. Some of these clearly aren't the case, right? Sector-wide, the market is up. Individually, assets generally are up. So what can we do? We can buy productive assets and we can earn yield. If I'm in a situation where I'm able to earn, let's say that I can earn 20%, just as a number, okay? If I can earn 20% yield in cash flow, then even if we saw a decline of, let's say, 20%, I'm still at break even, right? So that's not too bad a situation. On the other hand, if things stay flat, hey, I got some returns. And if things go up, well, then I got some returns plus whatever appreciation I had. That's a good situation to me in today's market. At the same time, you could look at diversity, right? Now, diversification, I think in a situation where mostly everything is inflated, helps you less than normal, right? The question is like, what do you diversify into? So my general approach is to, first of all, diversify across some different cash flowing assets. Okay, so that's the first point. We'll talk specifically about what those are in a second. Number two, I'm very interested in liquidity. And the reason for this is because I want to be in a situation where if it turns out that the market's taken down, and to be honest with you, I'm not expecting a major market correction, right? I'm not expecting some 50% drawdown in general markets in 2022. Maybe it will be happening, but I don't think it will happen. Or I consider it to be a low probability event. So if that's the case, then I do want to be able to take advantage of it, which requires some sort of liquidity, okay? What are the ways that I can get that? Well, a couple different options. So I've mentioned some previously. I have access to some arbitrage funds that I think are really interesting. So that has virtually 100% liquidity, as well as pretty good cash flow. It's a variable cash flow, so it's hard to predict. This past year it was really good. This year, maybe it'll be down lower, but you can expect reasonable cash flow with some decent upside potential on the cash flow side. It's mostly based on the volatility of the market. So that's good, that's interesting, right? Number two, I think overlooked by a lot of people or underappreciated are yield farming strategies. This doesn't have to be yield farming per se. It could be just, lending, staking. If you look at various different staking environments, now the underlying asset might have volatility, but the staking rewards can be pretty safe and secure, meaning that you're not likely to have your funds lost, right? So let's use a simple example. If you were to deposit Ethereum into ETH 2.0 staking, that's not one I would recommend because you'd lose the liquidity, but we're just going to use it as an example. The likelihood that you're going to lose your ETH is quite small. And at the same time, you get some yield. Amazing. There's a lot of different protocols that you can do that with. Some you can do it with stable coins, some you can do it without. I've talked a bunch on this channel about various different strategies there, insurance and things like that to mitigate risk. Bottom line is you can be in a situation where this definitely helps to mitigate your risk. So I'm heavily interested in those types of strategies in the current environment. Okay? Additionally, in my opinion, what we should be looking at here is because we don't know, are we going to be in an inflationary environment or a deflationary environment this year? What's going to happen in that regard? I want a combination of assets on each side. Okay, so the arbitrage fund option is something that I have liquidity, I have yield, and if it turns out that asset prices go down, I'm good because it's based on more or less a fixed dollar amount. I can equally do this with stable coins or other similar kind of lending products. So that's good, but I also want the opposite. So on the opposite side, I think there's two main asset classes that I'm interested in. So, or maybe three if I can find them. So if I can find good dividend paying stocks that are like solid companies, etc., I like that. Number two, if there are solid projects in the crypto space where I can earn good yield, I'm interested in that. And three, I'm more interested this year than I have been in a bunch of previous years in cash flowing real estate. I think that probably cash flow in real estate is underappreciated right now. And so I'm interested in finding opportunities where I can get that. Now, yes, there's some other things out there where you can engage in flips, there's trading, there's active strategies like that. But to me, these are the main areas to look at. And if it turns out that the real estate goes up and I have good yield along the way, well, I can take profits and I can turn around and I can roll that into something else. If it turns out it goes down, I have some mitigation with the cash flow. I don't want to be solely in that. I want, a portion of my portfolio that makes sense there. But I'm hopefully buying assets that I'm going to be able to weather, go through that storm anyway. So that's my perspective. I would love to hear your perspective on it. I'm interested in particular in kind of like the macro thesis of where we are and how you think you can maximize risk to reward, etc. But main things for me, number one, focusing heavily on cash flow, focusing heavily on liquidity, and focusing on diversifying between assets that will go up if the market goes up and assets that won't go down if the market goes down. So I have a little bit of correction on either side. That's, from my perspective, the best strategy at this point in time looking at 2022. So let me know what you think, and I'm going to look forward to seeing you on the next video.